Hello and welcome to BQ Prime. You're joining us on this special sort of a video conversation that we're having in light of HDFC Limited merging with HDFC Bank. And for this conversation, I have with me Mr. V.S. Rangan, the Executive Director and Chief Financial Officer of HDFC Limited, India's largest mortgage lender. Mr. Rangan, firstly, welcome to this conversation. I want to start with a little bit of look back on your career at HDFC. When did you start? How did all of that work out for you?
So it's a very long journey. It's almost a 40 years now. I joined HDFC in 83 after I finished my CA, which was obviously I passed out on merit and I had various choices to take while at that point in time. But I mean, rightly or wrongly, I had at that point in time the to stay in Delhi actually. So this came in through some references and all, and I didn't know too much about HDFC at that point in time. It was a very small organization, but I knew that it is a growing organization, and so I started in the accounts department, and then from there on moved into various other functions, credit, fundraising, and some bit of licensing with the various regulators and all that, and moved eventually to Bombay in 2001. And in 2010, I was inducted into the board of HDFC Limited, and from there on, started taking more higher responsibilities on the corporate functions and all that. So that's how the journey actually started for me, and it continues as we are talking. Yeah.
So, since we are looking at it from a point of view of when the company started, housing finance was not really that big a concept outside of the banking industry. You're probably one of the earliest in the non-banking space to focus specifically on this. I just want to understand from you, how do you think this market has evolved over the last 40 years that you've been associated with the company?
So the initial years I recall, in the early 80s or whatever, I mean, nobody really believed that this concept is going to work, given the fact that in India, the house, when you give a loan, the mortgages are never perfect actually. You don't have, all the time, you don't have registered mortgages. Registered mortgages are expensive. So we used to do what is called as mortgage by deposit of title deeds. And everybody believed that, this would be something which may not be really working out because people default, you may not have ability to raise money and all that stuff. So that's how the whole background started. But the key thing I think was our chairman, the former H.T. Parekh, who started this. He had a vision, and the way these institutions work both in UK and US. And he was very clear that this is something which India needs, and it should be possible to, if you lend to right persons with, and if he's going to buy a house, he's never going to default just for the sake of losing his property, and disputing the property. So that's a fundamental base on which the whole thing was sort of built up. While some people had suspicion at that point in time, but there were, as the thing started growing, I think somewhere in 2000 or so, I think it became very clear that this is a business which is very, very long-term growth and all. And you also start seeing the banks and others coming into this segment. Otherwise, the banks used to traditionally lend to the industries and project funding and all that stuff, never on the retail side, particularly in mortgages. So somewhere in 2000, you saw that trend of, the banks started to come into this market. And thereafter, of course, it is a story which is well written about and articulated, and still continuing actually now as we are talking now. And we have been able to demonstrate a very high quality of portfolio. The Indians by nature, they would want to sort of protect their property at any cost, even if they have a problem. And secondly, despite the fact that there have been legislative changes, there are foreclosure law which has come in now, which was not there at that time. All that has helped in a certain way for others to come into the segment. But by and large, I think this industry has remained quite sort of stable, I must say, both in terms of growth as well as in terms of performance of this portfolio. And the enforcement in terms of foreclosure and all has been very, very small in relation to the overall mortgage size which is there. And we are still very underpenetrated in terms of this industry.
Correct.
So I think there is still a lot of legroom for growth, and I mean, with India growing and India actually expanding into various, smaller towns and cities and urbanization,
Right.
I think we'll have to see this to be growing from here on for many years actually.
So you mentioned legislative changes. Now, apart from that, there's also been a host of regulatory changes. I mean, one of the reasons why the merger was, I mean, the rationale that given for the merger itself was the fact that the regulations have changed to a point where there is really no point in having two separate lending entities, one bank and one non-bank. And it makes sense to have them come together. Take us through a little bit about how regulations changed and how HDFC actually managed to sort of work around them.
So if you actually go back to the history when HDFC started, there was no regulator actually. I mean, the whole NHB concept actually
Yeah.
took birth much later when we had almost done 10 years of business.
Yeah.
Then only the NHB was born. But before that, it was like a normal NBFC, like a normal RBI registration and all that stuff. But the specific regulation for the housing finance company started with NHB coming into the picture and taking over the role from RBI to that extent. From there on, what we have seen is that whenever there has been a regulatory change in the RBI scheme of things, either for the banks or for the NBFCs, there has been a parallel change which has been also been sort of happening in the housing. But considering that housing is a long-term asset, it is a more stable asset, and this thing, so some of the changes are actually different for housing finance companies relative to the normal NBFCs. Having said that, I think all the regulators, whether it is NHB or the RBI, they are very much given to the fact that we need to have coexistence of both NBFCs as well as the banks. And that's how this whole the growth has happened across NBFCs as well as the banks. And somewhere I think in the late last few years, I think there is also a discussion around the sort of aligning some of the scale-based regulations, where effectively we are saying that beyond a certain scale, if an institution is there in the financial sector, then you need to be actually governed maybe differently or more closer like a bank type of regulation. So that's where we saw the emergence of the new set of regulations, whether
Right.
it is on building up the balance sheet strength in terms of LCR requirements, or whether it is in terms of capital adequacy requirement for larger institutions, or the NPA sort of recognition of the banks versus the NBFCs. All that actually was actually the culmination of this whole integration happening between, from a regulatory perspective, this thing, but the existence of these institutions for the purpose of providing the services to the last mile customers,
Yeah.
that is not actually sort of questioned by any either the policy framework or by the regulators. It is more about how you govern it, whether you carry enough capital, whether you have enough risk management systems. So around that, there is a lot of this thing, convergence which has been sort of brought about. And obviously, as you become larger, your ability to manage the risk and in terms of keeping enough this thing to sort of weather away some of the, like you pass through a lot of macro sort of issues, whether it is pandemic, whether it is global failures and all that. So that managing that in the context of a size is very important. So that's where I think some of the convergence of these regulations are also coming in.
Okay. Coming to the merger itself, now we're watching two large financial sector entities coming together, forming an even larger company, one of the top in India, even globally, in the top 10, top 15, I'm assuming. But tell me a little bit about the scope of this merger. When we're talking about such large entities coming together, there must be a whole host of things that need to be resolved before the actual merger takes place. If you can just take us through what the scope looks like.
So basically, the merger involves 3-4 areas which are very critical. One is you have a set of institution which is there on the other side, which is a highly regulated bank, which are very highly regulated institutions. Here you have large NBFCs, which is also regulated on a scale based, but relatively little lesser compared to the bank. So there is a difference in terms of regulatory framework between both the institutions. So to that extent, there are certain areas where you will require certain RBI forbearances or roadmap to actually sort of converge it into the bank sort of regulations. So that is one set of things which were need to be sort of taken to the regulators and asked for this thing. And the second important thing is obviously the whole requirement of the IT framework. The banks are actually sort of on a live system, whereas NBFCs, they don't do continuous transactions with the customers. So to that extent, as we are merging into the bank, and there could be customers who could be uh, customers of both HDFC Bank and HDFC Limited. And on day one, when the bank customer is opening his net banking, you should be able to see the HDFC loan there actually in whichever form. So those are some of the things which needs to be prepared and have to be ready. Without that, you really cannot fulfill certain part of the requirement. So that is the second part. The third obviously is the business and overlap and all that. Fortunately for us, this product was never there with the bank, and they were only distributing it. So they used to buy from us, and that is what the book they have today. About 1 lakh crore of book they have, which they have bought from us. And they also, the bank also realized at some point in time that they need to have long-term assets, and so far they have been having only short-term assets. So to that extent, it builds up a large balance sheet for them, stable balance sheet and stable portfolio. So the mortgage itself will become almost 30% of their, the total
loan book
advances. So it's a very significant part, and it also basically has a growth potential as we see it. And as you are able to sort of merge it into the bank, you can offer certain products which only in a banking framework you can give. For example, if you want to have a OD type of a product, where a customer, if he has a surplus, he can sweep it into his mortgage and then draw it back later on or whatever it is. So those are products which can be offered only in the banking system.
Correct.
We cannot offer it in the NBFCs. It is not possible to offer those products. So that is the other, sort of opportunity which comes in. And the larger part is obviously the customer base. So we have a whole set of customer base within HDFC Limited, mortgage customers, deposit customers. We have a deposit base of close to about 1.6 trillion rupees. And we have a mortgage customers, which are almost 4 million mortgage customers are there. Then there are customers in the insurance and asset management and all that. And similarly, there are a whole lot of customers on the banking side, which are liability customers and wealth customers and all that. So in terms of cross-selling mortgage products to their customers, or cross-selling the liability products of the banks to our customers, those become quite sort of a opportunity to fund the growth of the mortgage business which goes into the bank. So those are the sort of opportunities, and of course the challenges I talked about. Largely it is to do around the regulatory this thing, to see that we converge into the bank in a manner that some of the things are achieved over a period of time, like a PSL and other this thing. You can't achieve on a day one because the PSL requirements are very large.
But the
So
Reserve
those are
Bank has
some of
given
the
time.
things which comes out of the forbearances part. And of course, the last, of course, is the human this thing. But again, there is no duplication of people there, because the mortgage guys who are doing in HDFC Limited, they go as a, there is a shift and fit there actually. So except for certain very small changes around there, there is not much of a disturbance around the human part also.
One other question that I wanted to bring in is you're, apart from being a large housing finance lender, and because of the nature of the business you're in, you also borrow a lot of money from the market. In terms of the market borrowings, you've recently concluded 50,000 crore worth of NCD program, which was considered the largest in India till this point in time. I'm just curious to understand how these liabilities, I know you spoke a little bit about it, but if you can just detail that a little bit. So when these liabilities move to the bank as part of the merger, what does that make the bank's balance sheet? I mean, there is going to be some long-term capital available to them, but apart from that.
So basically on the liability side, we have been very flexible on the liability part. As an HDFC, when we used to raise liabilities, obviously since we are competing on the asset side with other banks and all, we need to be competitive enough in terms of offering those products at the right price. So to that extent, we need to raise liabilities which comes at various points in time at different cost. And so we pick and choose and also select certain liabilities which are, from a long-term perspective, it is good for us. Having said that, I think given the size of the balance sheet today, some of the liabilities, like for example, the deposits have become a very significant source of liabilities. And it is very stable actually. So when the interest rates go up or go down, these remain fairly stable in terms of their, the continuous inflows and outflows. So we have almost 1,60,000 crore of deposit base. And then of course the market borrowings, which consists mainly of commercial paper and NCDs. There of course it is very sensitive to the market interest rates and what the market believes the expected interest rates are going to be. It factors all those things. So there also you have opportunities to borrow when markets believe that the interest rates are going to keep on going down or whatever it is. So we have been using all these resources fully, and from a merger perspective, I think what it does is that most of these liabilities are actually, all of them will actually get grandfathered into the bank, because all of them are liabilities which are actually permitted for the banks, except one or two for which forbearance will be required. But what it does also, the fact that we have fairly reasonably long duration liabilities on the liability side, particularly in the bond which you talked about. In the last 1 year, we have raised close to more than 1,30,000 crore of 10-year money. So that basically helps in terms of replacing some of the liabilities through the deposits and others, as the bank starts putting down the machinery for raising incremental deposits. So it will basically help in terms of filling some of these refinancing of these liabilities in a smoother manner. The transition will be quite smoother. You don't have to replace a whole chunk of liabilities on day 1 or day 6 or day 6 months from the date of the merger.
Tell me a little bit about how this market has evolved for you. When you came in, there was nobody else like you, but now you have a whole market of people who borrow money from the market on a regular basis, say 5-year, 10-year money. What are some of the innovations that you've looked at?
So we have done quite a few, but I must say at the end of the day, the business we are in is a trust business.
Correct.
So anything and everything has to do with trust. So when you go to borrow money, obviously the trust plays a very, very important factor. And we have been quite lucky that from day one, we had a AAA rating all through. And we have been known for our governance practices and the fact that, it's a listed company, and our numbers are all known to the public, and it is AAA rated across, all these years. It gives a lot of sort of strength in terms of the balance sheet strength to go and borrow. And that's actually one of the reasons as to why we were able to raise such quantum of liabilities, and from institutions like the provident funds, the insurance companies, and even FIIs in those days, when FIIs used to be large investors in the bonds and commercial paper in the country. And over a period of time, we have been, since it's a growing balance sheet, we have to look for all the opportunities which are there to raise whatever forms of liabilities. So as and when their markets opened up, whether it is for issue of bonds to the FPIs, and or when the government actually opened up the rupee denominated masala bonds, though the market has not grown from there, but we were the first one to go there and raise this thing. And similarly, when the RBI came out with the ECBs for affordable housing, which can be raised by the housing finance companies, because normally ECBs are not permitted for housing finance companies, except where the amount is to be used for affordable housing. So that's a segment where we have, in the last few years, we have raised a lot of money.
Right.
And in fact, we raised one of the largest 1.5 billion ECB, which was permitted till December last year. So under the special window, we could actually go and raise that 1.5 billion at one shot. So all this obviously is coming on the back of the strong rating, given the fact that it is a mortgage, the delinquencies are very low, and the management and governance and other practices of this are found to be good by the investors. So I think everything has played a role in its own, wherever it is required to be. So it's not a person dependent or anything. Right. It is, I think, as I said, trust is an important factor in this whole scheme of things.
When you were talking about the merger itself, you're closely involved with the committees that are ensuring the integration between the two entities takes place in a smooth manner. What do you plan for your role once the merger is concluded?
So obviously nothing has been sort of stitched at this point in time. So only one thing is I must say, clear or this thing is that they want me to be there in the bank.
Hmm.
So in terms of the exact role and all, it is still getting worked out.
So this is going to be an executive role, is it?
In the board of the bank. So
Right.
that is the sort of thinking right now. But everything will obviously be subject to various approvals, whether it is RBI, whether it is shareholders approval. All that will have to follow once.
What do you think is it in terms of learnings that you're bringing to the table for the bank? And obviously, it's a business that they don't do actively, but also your team learning from the bank side of the story.
So obviously the bank has got a very high sort of compliance systems and this thing, so they are very strong at that. So no doubt about it. So there is a lot of learning to be done in terms of how they actually really go to implement a lot of compliance, this thing and all. And in the case of NBFCs, this has been more a light touch sort of regulations relative to what the banks are. So that is, I think, the learning which I will need to sort of get more deep into that. And as we are sitting in the integration committee, we are seeing a lot of these things coming. As far as this thing is concerned, obviously I've been a finance guy throughout my career, and my sort of specialization has been to see how the balance sheet is actually sort of funded for growth, what are the new opportunities you look at, and how you really, because the bank will have to sort of price this product appropriately, and natively they have to have liabilities which are actually sort of required for this type of operation. And those are some of the areas where I think I can probably contribute to this thing. Besides, of course, the fact that banks never had these types of various subsidiaries which we have. We have a whole lot of subsidiaries. And as a bank, when these subsidiaries go into the subsidiaries of the bank, there will be a lot of requirement with regard to, today also we have a lot of conglomerate reporting to the Reserve Bank and others. So those will become far more, frontline phased sort of an activity.
All right, Mr. Rangan, thank you so much for joining us on this conversation. Pleasure talking to you.
Thank you.